got my good buddy Jeff Snyder right here when we're talking about SWIFT, when we're talking about payment systems, when we're talking about the Eurodollar, banks in Russia, in Germany, in the United States, the Fed, chips, chaps, box, SIPs now, SIPs, CIPS. When we're talking about all these things, I don't know of any person on the planet Earth, quite literally, that knows more about this stuff than Jeff. So I wanted to bring him on today so he could help us understand this so we can determine the probabilities of specific outcomes happening in the future. I mean, the topic that's on everyone's mind right now is, will these sanctions or will Russia being kicked off the SWIFT system, how will this impact their economy? So, Jeff, do you want to start there? And then as you're explaining, I'll probably interject some questions so people can really understand kind of your lines of thinking.
Yeah, I think the overall view is most of the public is led to believe that the United States just kicked Russia out of the US dollar system.
Right.
Woe unto Russia because the hammer has come down. They've exercised the nuclear option. Russia is out of SWIFT. So what are the Russians going to do? And the answer is they're going to use the phone a lot more. That's all it really means.
Okay, so this was one of my questions that I had written down. I think I accidentally deleted it, but I wrote down some questions when I was just grabbing a coffee so I could kind of be, fully alert here. And I said, okay, if I want to transfer money to someone, like my sister has an account. We're both with a small bank in Kansas City. And I know the banker well. I know the guy that's VP of commercial lending. It's a good buddy of mine. And so I don't even call their customer service. I literally just call Dan and say, Dan, I need to move 100,000 down into Cass' account. Yeah, I'll make that happen. And I know it's between the bank, but why can't a German bank just call a Russian bank and say, hey, we need to get, $100 million over to you for some gas. Can you just go ahead and add $100 million to your liability side on this account? And, we'll just go ahead and either you can deduct that from our account that we have with you, or we can add that to your account that you have with us, or, we can send you some other dollar asset to match up with that liability. So what am I missing there?
You're missing the fact that there are two different processes at play here. And let's talk about specifically Russia. What happened? First of all, the United States doesn't get to decide who gets to use SWIFT or not, even though it's the primary mechanism by which the US dollar or the Eurodollar system operates. It's actually not owned by the U.S. government. It's not controlled by the U.S. government. It's not even really influenced by the U.S. government. It's a consortium of, I believe it's up to 519 banks around the world who control what SWIFT is. And the reason it's the banking system, because George, as you know well, we operate under Eurodollar standard, not dollar standard. And Eurodollar means bank-centered. It's essentially these interlocking networks of interbank relationships, of which SWIFT is only part of it. And that's only, again, going back to what you just said, it's only part of the process of transferring funds globally. The first part is you've got to send a message. You got to communicate your intention somewhere. And that's really all that SWIFT does. It's a messaging system. It is not a clearing system, nor is it, more importantly, it's not a settlement system. So all SWIFT does is it allows standardized messages to be transmitted globally at the push of a button. So what the United States did in concert with certain governments in Europe is they pressured some of these banks who operate in the SWIFT system until enough of them, probably a majority of them, said, we're going to restrict the codes for 10 Russian banks and not allow them to use the SWIFT messaging system, which simply means they can no longer use the messaging system to transmit their communications and their intentions across the network. But SWIFT is not the only messaging system that's available. In fact, it's the primary one in small value bank-to-bank transfers. There are other messaging systems as well as settlement and clearing networks and processes that actually include their own messaging system. CHIPS is a perfect example.
Well, let's get into CHIPS. So I think that's a good segue. So, and that was one of my questions. Does CHIPS have their own messaging system?
Yes, CHIPS has its own messaging. And really, chips and SWIFT work together seamlessly. In fact, I believe, the statistics are hard to come by, but the last one I saw said that 70 or 75% of all chips messages originate from a SWIFT message. So in other words, the bank gets a SWIFT message, it's mapped onto the chip system, and it operates as if the SWIFT and chips are seamless. But not all SWIFT messages are chips messages. In fact, chips has its own separate messaging system, and it works across the entire chips architecture. And the CHIPS architecture means that there are 43 participant banks who sponsor untold hundreds more banks for use on the settlement system. So let's say, for example, a couple of Russian banks that have been particularly targeted by the Treasury Department lately, they get kicked off of the SWIFT system, which means that their messages, their coded messages that have these two banks' codes on them, will no longer be transmitted or acceptable on SWIFT. They can switch over to say CHIPS, where it took me 2 seconds to find their UID numbers. I mean, Sberbank of Russia is 321233, and VT Bank is 306166, which means that on the CHIPS system, they can still send messages across the CHIPS network.
Right.
And even though, and the Treasury Department has gone a couple steps further here by sanctioning these two banks in particular, saying that U.S. financial firms, U.S. banks will no longer be allowed to operate any sort of pass-through or correspondent relationship with these two banks. So, that sounds like the United States government is slamming the door even harder on these particular two systemically important banks, when in fact, what the U.S. Treasury Department has actually said is that you probably didn't catch the qualifier, which was U.S. banks can't do pass-throughs or correspondent relationships with these two Russian banks. But as I just said before, CHIPS has 43 participating banks who are basically the nuts and bolts of the CHIPS system. Only 19 of those are American banks. A lot of the rest are European banks, but there's a bank from the UAE. There's a bank from Switzerland named UBS. There's 4 Chinese banks. So these two particular banks that can no longer have correspondent or pass-through relationships with U.S. firms can still maintain a correspondent or pass-through relationship, say, with the Industrial Bank of China. And so the Industrial Bank of China can operate on their behalf in chips. So, yeah, maybe the VTB Bank can't send SWIFT messages anymore, but it can still do high-volume, real-time netting processing through the chip system using this alternate methodology. So the idea that the United States has cut Russia off of the U.S. dollar system is just complete nonsense. They've made it a little bit more difficult, made it a little bit more cumbersome. And even in the low-value direct bank relationships where, the example you used, George, where, somebody wants to send a wire transfer overseas. Well, maybe the banks in Russia can't use, or these certain banks in Russia won't be able to use SWIFT, but they can go fall back on technology that's been used for decades. They can use the telephone. If you have a correspondent relationship with a bank outside the United States, guess what? You can pick up the phone to your bank in Switzerland and say, I'm going to wire you funds. And the bank in Switzerland will say, well, this is a little bit more cumbersome because I used to get a computer thing and it used to do it automatically. But you know what? I can take down your information on a piece of paper and we can still execute the same transaction. So kicking these Russian banks off of SWIFT, it's a minor annoyance. It's a nuisance. It makes their life a little bit more difficult, but it hardly has kicked Russia off the U.S. dollar system.
If it's just political theater, which is what it sounds like, then why is the ruble down 30% today? Is it because they tried to do the same thing to the Russian central bank? Is that have more of an impact, or is that the same type of political theater?
That would have more of an impact too, as would freezing Russian accounts, right? I mean, if that would be the true nuclear option, is if the United States government and really the Swiss government and some of the other offshore banking centers say, we're not going to kick them off the messaging system. We're going to freeze their accounts entirely. That would be the true nuclear option, but nobody's going to do that because of what it would do to the price of oil. And that's really the constraint here. So why is the Russian ruble down? Well, because Russia is going to pay an economic price. And really, Russia is a horrible investment at the moment. Anybody who's going to want to invest in Russia, or anybody who has investments in Russia, those are not going to pay off. So everybody is trying to flee Russia because of what's happened, not because of the sanctions, but because the risk return profile has changed so unfavorably, it's gotten completely asymmetric. So in monetary terms, what happens when you have a change in asymmetry like that? The currency just collapses. That's really what's happened to the ruble.
Yeah, so people just dump currency. So let's back up a little bit and go over what they actually did to the Russian central bank, and try to understand from a technical standpoint what they're doing, and then how that affects the central bank. If I'm not mistaken, it affects their ability to use their FX reserves to support the ruble, and that's why they jacked rates up to, what is it, 20% this morning.
Yeah, but you got to remember the Russians were anticipating all this to begin with. I mean, the Russians completely changed their liquidity profile ever since last March. And it wasn't coincidence that their liquidity profile changed in the same month that troops started to mass on Ukraine's border. What they did was they began to sell securities. They began to move more money into the accounts with foreign central banks and governments. We don't know which ones, but we can guess which ones. I mean, it's not really a big list of foreign central banks that are going to be welcoming higher involvement from the Russian counterparties. So over the last 9 months of 2021, as well as the information we have for January 2022, the Russians have been creating much more available liquidity, fewer securities. They drew down about $10 billion worth of deposits with commercial banks and added about $40 billion more in deposits with foreign central banks in December alone. So they had raised their liquidity profile long before any of this stuff. I mean, they knew what they were doing, and they knew what the Western response would be. So even though
these other central banks can try to prop up the ruble for them.
No, that's not the intent. The intent is, can we pay our bills? Can we pay for imports? Can we pay for trade? Can we accept US dollars when we sell energy overseas? That's really what's going on here. So the Russians have decided, look, we know what's going to happen once we invade Ukraine, so let's prepare for it. So they created essentially 30% of their reserve assets are now in the form of the most liquid deposit types of accounts. Mostly, I think 85% or 90%, I forget off the top of my head, are with foreign central banks and foreign governments. Not all foreign central banks and not all foreign governments, but I can guess that there's probably quite a few with their allies, maybe India, China, and others around the world. So again, going back to the idea that the Russians are cut off from the US dollar system entirely, it's really not true in any aspect of it. There's still various ways for the Russians to conduct business. Their problem is more economic, which is, unfortunately for the Russian people, they're going to pay the price in that way.
Yeah, through significant inflation.
Not only that, it's significant amounts of, as you say, lower amounts of activity.
Yeah, economic
the Russian economy is going to get hit with both sides of the coin here. As the ruble drops, that's going to make life incredibly hard, but also the fact that economic activity is going to fall off even more than it has. And remember, the Russian economy itself has been a horrible bet for the last decade, ever since 2011. Remember, Russia used to be one of the BRICs, in the early 2000s. The idea was Russia, China, Brazil, and India and South Africa. These were going to represent the countries that by 2050 were going to take over. They were going to grow themselves into preeminent roles in the global economy. Well, then 2008 happened, and really 2011 happened, and the Russian economy ever since 2011 has been flat to lower. So the Russian economy has already been in significant trouble, which is reflected in the ruble's price long before we got to this position, this stuff with Ukraine and sanctions and everything. So Russia has been in significant trouble all along, which I think goes part and parcel with some of their motivations for invading Ukraine in the first place. So in Putin's mind, I don't think he cares about any of these implications. He's got to do what he's got to do. As far as the Russian people and the Russian economy, they're taking the brunt of the downside of what is inevitably going to come their way.
Yeah, as it usually works out with people and politicians.
Absolutely.
So today I read in the media that they're saying, and these are the politicians in the West, saying they're really going to stick it to Russia and Putin because they're considering freezing Putin's war chest, quote unquote. So that goes back to what you were just saying, that
can they find it?
Yeah, there you go.
Yeah, and that's really the point. The Eurodollar system is not just a bank-centered monetary system. In many ways, it represents a computerized network. And what happens on the best computerized networks? You block part of it, and it finds a way to flow traffic around it. And that's really what's happening here, whether it's in the chip system or some other form of correspondent banking. it's a network of, it's an interconnected, complex network of monetary currency flows, whatever, economic transactions behind much of it. And if you try to cut off one part of it, it's just going to reroute to other parts. And that's really what's going to happen here. So, what you said before, this is mostly just optics and political theater, because, everybody has this impression that the U.S. just cut Russia off from the dollar, and this is a nuclear option. It's really going to hurt. It's really going to hurt the Russian economy, because, we need to punish them for what they've done. And that's really not the case at all. And it represents really the impotence that U.S. authorities, but also, governments around the world have. They can't redirect the monetary flows of this global system, because it is a global system. It is a system of banks that are they're spread out all over the world. And they have, over the last 50 years, developed all these different ways of communicating and transacting with each other that most politicians probably don't even know exist.
Yeah, I mean, that reminds me of that story that you told Eric about the guy at Solomon Brothers. I don't want to get into it. I'll actually go into it on a whiteboard, but that just illustrates so many of the points that you make. But
also, George, I mean, remember what the narrative is not just for about foreign audiences or for Russian audiences. It's also for American audiences too, right? Yeah. It's reinforcing this idea that the Treasury Department or the Federal Reserve, they're in charge of the dollar system. And so if they kick you off SWIFT, you're kicked out of the US dollar. No, they want to keep the idea fresh in the public's mind that they are in charge. It's the US dollar system. It's ours. We control it. And so that's really part of the optics here. It's inward facing an American audience, trying to continue to reinforce this message that it's US dollar, it's American dollars. When the truth is, if you actually look at it, spend a little bit of time on it, you can see it's euro dollar. It's outside the US. It's bank centered. There's very little influence of direct influence by governments or central banks in it.
I think why most people have a hard time with that, Jeff, is because they don't understand. They might not be conscious, but subconsciously, I don't think they understand how a banking system can work that is reserveless.
Yes.
And I know you've said that so many times. The Eurodollar system is reserveless and it's cashless. And I think people may hear that in passing and just they don't pay much attention to it. But that is crucial that people understand that, and very few do. So let's just take it down to its basics here and try to figure out, if you got two banks in the Eurodollar system and one is transferring money, quote unquote, to the other one. Effectively, what they're doing is they're transferring a bank liability. So let's just say it's $1 million from person A to person B's account, and they're with two separate banks. So if we're adding a liability to the one bank's balance sheet, we've got to do something to offset that liability. Now, most people would say, oh, well, they're sending them dollars, quote unquote. Therefore, if the Treasury controls that, if the Fed controls it through Basel III or through regulations or reserve requirements or something like that, the final settlement has to be in dollar denominated bank reserves, which the Fed controls. So obviously they're center of the universe. But what they need to understand is there's other ways to settle that transaction. There's other ways that that bank that received the liability can have an offsetting asset. And number one, they could transfer them a dollar asset, say a bank reserve. They could do that. Or they could just, bank B could deduct, let's say, the $1 million or whatever the initial or whatever the transaction was from bank A's or the sending bank's account that they have with them. I think that's called a nostro or vostro account. Right. Or that the sending bank could just go ahead and add the $1 million to the nostro or vostro account. Yep. For the receiving bank. Those are three different ways to make sure that the balance sheets add up.
Match. They always add up. Exactly. And that's really
fourth or fifth that I'm missing, or is that
no? George, what you just described is simple correspondent banking, that it goes back into the hundreds of years. It's really back then there used to be paper transactions. What was called bankers' acceptances, that the market for those that existed for a very long time before before the 20th century. It's really simple mechanics. And again, as long as your assets and liabilities add up at the end of the day, and they add up to the same amount that's on the other side, all that's changed in this Eurodollar system is the speed at which these transactions take place and settle. And so the simplest relationship is what you just described, which is a simple low volume or low value transaction between two banks that already have a correspondent relationship. And the easiest thing to do is to say, well, I have a correspondent balance with you, Bank B, just deduct the funds from that balance, and we're all set. We have liability that's exchanged hands. We have assets that move back and forth, numbers that move up and down on the computer screen. And at the end of the day, our ledgers all point to the same amounts. They all equal each other. So something got done, even though there was no cash involved, no physical cash involved. There was no money transfer, but there was an exchange on computer screens. And so that's why the Eurodollar system is this, it looks like a computer network, because that's essentially what it is.
Yeah, of just these ledgers.
Just ledgers. That's really, that's why accounting is so important in understanding these money flows, because it's mostly based on the accounting rules.
Yeah. Yeah, and I've never taken accounting class, so maybe that's why I struggle so much. But okay, so then now I think maybe some pushback would be, well, I think the next step is for people, once they get that, then they need to understand that the bank's balance sheets are not constrained, because they can create those, even if they're not funding, let's say the Nostros account or the Nostro account with bank reserves, they can simply fund it through an extension of credit that the counterparty bank gives them. So then the liability would be the credit or the line of credit, if you want to look at it that way. And then the asset would just be the loan. And then they could just do that for each other. So there wouldn't even have to be a funding mechanism.
Absolutely.
It's just that extension of credit, because those balance sheets and those ledgers at the end of the day match up. So let's move.
Well, then beyond that, this is the customer that you created a balance for could then transfer it to another bank and then can use it someplace else. It can use it in the real economy. So even though there's no cash there, this fictional ledger creation actually can be used in the real economy for real economy purposes. So for all intents and purposes, even though it's not physical cash, even though it's not money that most people conceive of, it's still useful money in every single way that you can imagine.
Yeah. I concluded a whiteboard video that I did last week, and the title of the whiteboard video is something about something like secrets of money printing, right? Where I kind of went through all this, and the very last line of the whiteboard video is money printing, or what increases money supply at a global level, really boils down to simply commercial bank balance sheet management plus perceived counterparty risk. That's it.
And that's what, I was going to say, what you said before, that theoretically this reserveless system is unlimited. I suppose in the purest sense of the word theory, that's possible, or that's maybe possible, but no, it's not. It has its own set of governing dynamics and its own set of constraints and limitations that just have nothing to do with central bank policies or government regulations.
So what does constrain it? Because most people,
you just said it, balance sheet mechanics and counterparty trust. And balance sheet mechanics are all about, we talked about this in person the last time I saw you. Balance sheet mechanics are all about, guarantees, things like derivatives, contracts that are like insurance, where, I maybe have a risky asset that I just created, but then I buy some kind of protection from some other firm, so that it all goes on the balance sheet in a particular way, so that it's capital charge or it's risk charge or whatever balance sheet governance are enforced at that point. We can stay within the boundaries that you're given. So there's always some form of internal constraint.
You can play by the rules, but at the same time, because you can manipulate your balance sheet to such a great degree through this financial engineering, that you can literally create as many dollars as you want. You can create as many loans as you want. There's never, see, what most people think constrain the banks is money, or a lack of money, or a lack of dollars. And I always say, no. They can create the dollar. They can create the asset, the dollar assets. They can create the dollar liabilities. So that doesn't constrain them at all. And so then people look at, reserve requirements or Basel III, and then they don't understand that the bank is so good at just getting around that. So just to prove that
Well, no, you
point.
don't. I mean, reserve requirements that's something that, we had to worry about in the 20s and 30s. That's an economy it's a monetary system that doesn't exist anymore.
Right.
Hand-to-hand cash is not something people use. In 2008 was a perfect example. It was a bank run, but it was an interbank run, not a bank run into physical cash. It wasn't like people were queued up at ATMs trying to withdraw cash, which is what reserve requirements are about. Do you have enough physical cash to meet the demands of the public that wants to convert their liabilities into physical cash? Outside of a few examples like Northern Rock in the UK, that didn't happen anywhere because nobody uses physical cash anymore. It's all about interbank ledger transfers. And that's where the panic actually went into. So reserve requirements, having actual physical Federal Reserve notes in a vault or an ATM somewhere, that's no constraint whatsoever because hardly anybody uses cash.
Right. Well, so I think the disconnect there with people is they'd be like, yeah, Jeff, I get that, but they have to have the bank reserves at the Fed to back up the deposits. You got 10%, you got $1 million in bank reserves, and you can get it.
Yeah, but as you said, that's just a
loan.
regulatory requirement that's easily manipulated and bypassed. And that's really kind of the secret behind much of this balance sheet stuff is, yes, there are certain regulations about how you govern your balance sheet, but most of them are immaterial to the real world and how the real world actually works. So you have to put on a public face that says, yes, we're keeping up with these regulations, but these regulations don't really mean much.
Yeah. So I want to back up. Then I want to get to this, a couple slides that you went over with our good friend, Eric Townsend on Macro Voices, probably 4 or 5 years ago. But I really dove into them this weekend, and they're incredible. But I think what most people really struggle with is that banks don't need dollars because they can create their own. Because I was talking to a lot of the XRP guys this weekend on Twitter. A lot of them were giving me a hard time. And because I was trying to explain, because they look at these Nostro and Vostro accounts as though that's the silver bullet. Because all of these banks and all of these corporations, or let's focus on the banks, have to fund these accounts for all these transactions going across the international borders and whatnot, going from Mexican pesos to yen to euros. And, we've got all these trillions and trillions and trillions of dollars that the banks and their capital is locked up in all of these accounts that they have to have. So if we could just get rid of the need for those accounts, then the banks could take all of those dollars and they could use them to create more loans and all of this additional economic activity. And I'm like, no, guys, you don't understand.
There's no dollars.
Well, no, there's no dollars, but they're not constrained by that because
No.
they can make as many as they want to the extension of credit,
Right.
Bank to bank. And this, again, that's what people struggle with, is because I guess they just see the bank as needing dollars and not creating them. How would you explain that to a layman?
You're right. It's hard to explain, but yes, we're all in this previous anachronistic mindset of fractional reserve lending, right? That in order for a bank to lend out funds, it has to have cash in a vault. So George, you got to go into your local bank with a stack of cash and you deposit it, you physically deposit that into the vault. And then the bank fractionally reserve lends off that, which means it gives me a claim on it, gives another guy a claim on it. It would say there's 9 or 10 other people who have the right to claim that physical cash. And so that physical cash becomes the constraint, at least if in the 19th century world of banking. But nowadays, since we don't use cash, nobody uses cash, everything is a ledger entry. What is it that governs the amount of loans a bank can give out if it's not the vault cash? It's really these balance sheet mechanics, these balance sheet techniques that banks they've been using, they've been pioneering, they've been perfecting for a very, very long time. And so what a bank really is, it's not a store of physical cash or gold or anything like that becomes a fractional reserve lender. It is essentially an accountant. It is a bookkeeper that's balanced with something like a financial expert or an expert in marketplaces that can identify risk return characteristics that the bank finds attractive enough to expand its balance sheet into those marketplaces.
That's right.
So it's really mostly accounting.
Yeah, there you go. So to prove that, guys, and just if you're not following what Jeff is saying exactly, don't worry about it, because I'm going to do another whiteboard video on this specific topic this week. So as long as I understand it, then I can explain it to other people. So,
No, George, the problem is it's so counterintuitive, it's so abstract that it is very difficult to understand unless you get really involved in it and really appreciate it. And once you get past that one intellectual hurdle where you're not tied to the traditional definitions of money and banking, it's a significant block in terms of understanding what's really happening here.
Yeah, and that's really an epiphany moment for, I think, everyone. If they just understand that there is no constraint on the banking system other than just counterparty risk and their ability to manage their balance sheet. So because let's go back to quantitative easing, Jeff, a favorite topic of yours. People always say, well, if the Fed does QE, then the banks have all this cash, so then they can create all those loans or all those additional loans, and then they can give to the hedge funds, and they can go into the.
That's not how it works either.
But this is
there's so many misconceptions about. But you're right. That's the common
them talking, not me. This is them talking. So they view quantitative easing as a way for now the banks have all this extra money. But what that implies is that the banks were balance sheet constrained to begin with. And once you understand that they're not, then it allows you to see the world for what it is, I think.
Right. If you can't create a risky asset because your balance sheet doesn't allow for that risky asset to be created, it doesn't matter how many bank reserves you have, because your balance sheet is constrained regardless.
Yeah. Okay. So just to prove that point here, to further illustrate that point, let's go over to these charts that you went over with our good buddy Eric Townsend. And let's just start from the beginning. We'll try to shoot through it so people really get it. So you start with just, looks like one of my whiteboard videos almost. We've got the kind of the T balance sheet, the assets liability of Bank A and Bank B. And do you want to go ahead and just explain this to people, Jeff? And I'll just kind of try to clarify things as I think people need clarification.
Yeah, actually, George, I actually took the starting point from these. I don't think this is the exact starting point I used, but I actually took it from a Federal Reserve paper from 2009 or 2010 that was actually called "Why Banks Have So Many Bank Reserves," or something along those lines, going off the top of my head. And so we're really using the Fed's own figures to illustrate what are beyond the Federal Reserve. And the Fed's conclusion, by the way, was that the level of bank reserves in the system are nothing more than a byproduct of monetary policy. It doesn't tell you anything about the situation in banking markets or money. It just tells you what the Fed has done. And so the simple example we have here, we can illustrate why that's the case, that the bank reserves are nothing more than Federal Reserve action that kind of is not very interesting or very relevant to the situation.
Yeah. And what you're illustrating is how a bank can get around, or banks plural, can get around Basel III, because you're talking to Eric about initially the regulators were really hyper-focused on the liability side of the bank's balance sheet. But then they said, okay, well, that's a waste of time. Let's move over to the asset side of the bank's balance sheet. So instead of saying you've got a reserve requirement, now you've got a capital ratio.
Yeah, and that goes part and parcel with the Eurodollar story too, right? Because liabilities are the money side. And back in the old days, you used to have real money in there, but then the Eurodollar came along, repo came along, and all these other qualitative expansions in the monetary system, which made it to the point where central bankers and authorities and regulators couldn't understand what's going on in money. So it didn't make sense to tie bank regulations to the liability side when you can't really understand what's going on there anyway. So as a workaround, the first Basel Agreement came out of some work in the 1970s, but by the early 1980s, they said, we're going to impart capital ratio control over these banking systems, because what we're going to basically say is we have no idea what you're doing on the money side, but we'll give people a sense of what you're doing on the asset side. Therefore, people can have an idea whether or not you're being risky or not. Because it used to be risky was defined by liabilities. If you had too many claims on that amount of cash was in a vault, then people would get nervous and then they would run to the bank and try to withdraw their deposits. Nowadays, since we don't have that cash constraint, it's more about, do people perceive your riskiness based on the assets you include on the balance sheet?
Right.
Therefore,
right.
we should assign more of a capital constraint to banks who do a lot of risky things on their asset side.
Right. Which is which in my opinion is an admission that the only constraint is perceived counterparty risk.
Absolutely. And that really is the case. And that's what we're really trying to do here.
All right. So I think
and part of it too is internal. We're also self-dilution. It's very self-diluted here, because a lot of these risk controls that we're going to talk about and go through are basically, I mean, it's not real risk control. It's an accounting. It's an accounting fiction.
Right. So I think this is where you started with Eric. And so this is kind of the regulators came in and they said, okay, what we're going to do, all of the assets that can be on a commercial bank's balance sheet, we're going to give it a risk weighting. So the riskiest assets will require a 100% risk weighting, meaning that you have to have more capital to back up those assets. And it goes all the way to the far right where there's a zero risk weighting, where you don't have to have any capital to back this up because it's a cash or cash equivalent, i.e. T-bill, something like that. So do you want to start here?
Sure. And to be clear here, these are the original Basel rules. They've gotten more complicated and more complex over the years. Okay. But I think this is a good starting place so you can understand balance sheet mechanics as we're talking about.
Yeah.
And I think most people would look at that and say, if I'm a bank, I want everything to be in the lowest risk bucket I can find, right? Because that means for every dollar of capital, I can have a lot more assets, because that's what we're really talking about, is balance sheet efficiency. If it's a lower risk weighted asset, that means I can have more of those assets per unit of capital. Right. And so right away, you realize there's going to be an inordinate amount of attention paid, or a lot of desire to see if we can get the riskiest assets to look like the least risky assets, so that we can have more risky assets per unit of capital or per unit of balance sheet space. So that's really what we're talking about here, is balance sheet capacity and space, and how do we fit things into our balance sheet.
Right. So if we, just to give the audience some real numbers, if we have 1 billion in assets of the perceived riskiest assets, then we need an 8% capital ratio. So we'd have to have $80 million worth of capital. But if we had the same $1 billion worth of cash or T-bills, then we would have to have $0 in capital. So your point is the banks are going to want to try to make the risky assets that are the most high yielding, most likely, that they need $80 million. We want to make those look like the least risky. So we have to have $0 million.
Or if not $0 million, but something a lot less than the full amount. And these rules actually do make some sense, because the intent behind this is to say, look, if you hold a lot of risky loans, the chances are some of them are going to go bad. And so you need to hold more capital against those losses so that the bank doesn't go out of business. Right. And so there is some logic behind what the international regulators were trying to do here. And it's just that you can't open these doors for the banking system, because they will find every single way to exploit them.
Right. Right. So let's go down here and again, give people real world numbers and kind of walk them through how this would work. So then we start with, now that we understand kind of the Basel rule, then we look at Bank A and Bank B, and Bank A basically loans $40 to Bank B. So that becomes a liability on Bank B's balance sheet, an asset on Bank A's balance sheet. They start with, what was it, $10 in reserves. So now they have $50 in reserves.
And this is after, I think what we're seeing here is that this is after a transaction, a QE transaction, where the level of reserves goes up. If I'm remembering this correctly.
Yeah, I don't, let's see, maybe I could, this was the prior slide where you talk about LTCM here. And then the prior slide to that. Yeah, I'm not sure with the discussion. I don't recall.
I don't think it's immaterial I think it's immaterial for the discussion we're going forward, but that's where the reserves come from. The reserves come from the central bank activity. So at this point, I don't think it really matters, because reserves are nothing more than a liquid asset.
Okay. So Bank A lends Bank B the $40. And I think they lend them the reserves, Jeff. But anyway, let's keep moving on here. So the next step is these are the options that Bank B can purchase, going back to those Basel risk weighting.
Right. Now that you have the balance due from Bank A, which is essentially an interbank loan, right?
Mm-hmm.
What do you do with it? It's not
Yep.
the reserves you're putting to work. It's the cash that you've borrowed in repo or in unsecured markets or whatever. So the reserves pertain to the Federal Reserve. So that's all monetary policy. That's not what we're talking about here, unless we're talking about cash. Maybe that's probably, you should have labeled it more, labeled it better here. So the reserves that are on the slide here are not bank reserves. They're reserves as in terms of cash or cash equivalents.
Okay.
So Bank B now has an interbank loan for $40, which means it can do something with this cash that it has on its balance sheet. What does it want to do? And that's really where we're at the decision point here, where you're Bank B, you've got some cash, you want to put it to work. What are you going to do with it?
Okay. So then what they choose to do is, what they could choose to do is the riskiest assets, because they want the highest return. So initially, we'll say that they buy the risky mortgages and with the highest capital ratio requirement.
Yeah, and because, as you said before, they want to do this because it's the highest yielding asset.
Mm-hmm.
However, that takes a lot of balance sheet capacity, and you can see what happens to their capital ratio. It drops down to 7.14%, which is below the requirement, which means they can't do this as the balance sheet is currently designed or currently constructed.
Right. And just as a reminder, guys, the capital or the ratio here required is 8%, a minimum of 8%. And so then you're pointing out, and I think you'll get into this further, that the current leverage ratio is 14-1.
Yeah, and the leverage ratio is different from the capital ratio. The leverage ratio is essentially the actual amount of capital on the balance sheet versus the actual amount of assets, not the risk-weighted assets or any manipulated calculation for the assets, but how many assets are actually appearing on the balance sheet.
Right.
And so the leverage goes up to 14-1, the capital ratio falls to 7%, and this doesn't work.
Yeah. So now moving on, we go to a way that they could do some slick engineering, or they could just buy a different asset, I guess, that is a different risk ratio or allocation.
Yeah, qualified residential mortgages sounds like these are higher tier, higher quality assets, at least in terms of regulatory treatment, which means they're given a 50% risk weighting, which means that leads to a capital ratio above 8%, but still the 14-1 leverage. So this one you could do. This would be acceptable to regulatory rules. And by the way, let's specify here too that this is by no means realistic or real world examples. These are just highly stylized illustrations, just to demonstrate the concept. This is not exactly how it works.
Yeah. Okay. Moving on. Or you're giving an example of where they could do something a little less risky or perceived risk, but yet lower yield. And this takes their ratio to 9.25%. So well above the 8%. They're good to go with that. And of course, they'd be good to go if they just bought the US Treasuries, which is next year, using that as an example. So now it's all the way up to 10%. But this, to your point, is not going to make the bankers any bonuses. This isn't going to make them happy. So like, no, hell no, we don't. We got to figure out a way around this nonsense.
We got to have a higher return. Yes.
Yeah. So that's when they start doing some of the things that we were talking about. And this is a great illustration as to how they can have their cake and eat it too.
Essentially, yeah. How do we make the risky assets look like they're not risky assets? How do we turn subprime mortgage bonds into U.S. Treasuries for not just the Basel accounting and risk weighting treatments, but also use them as collateral and repo and some of the funding techniques as well. And if, during the pre-crisis era, there was any number of ways to do this, which, by the way, was the whole point behind securitization to begin with, was to take risky, illiquid loans, package them together to create securities that we could then define the risk characteristics, so that it would be easier to quantify and therefore fit them on the balance sheet in these kinds of using these kinds of techniques.
Okay, so here you're illustrating just basically how they would buy the risky mortgages, but make them look like the not risky mortgages by buying an insurance policy, which is called a credit default swap,
Yep.
from A.
So all you have to do, you find a highly rated counterparty, which were usually insurance companies, by the way, like AIG, and you would say, I have this $40 in risky mortgage bonds that I want to guarantee in case of any sort of loss. And AIG says, pay me, X number of dollars for the premium on the credit default swap. And the real secret leverage here is in how this changes what used to be a high, it used to take up a lot of balance sheet capacity as a risky mortgage, but now you've transformed it into what seems like a safe mortgage bond, and therefore requires so much less capital against it. You can then leverage up a hell of a lot more because you've made what is a risky asset into what seems like a safe asset.
By purchasing insurance against the quote unquote risky asset, you have made it far less risky, even in the eyes of the regulators.
And the other thing is that, both the insurance company selling the credit default swap as well as the bank buying it, neither of those parties ever expected that these default swaps would be triggered. And that wasn't, what you're essentially purchasing is not hedging. You're purchasing the ability to manipulate your balance sheet. So banks were only too willing to pay that premium because they were purchasing leverage. And banks or insurance companies like AIG were only too willing to sell it because it was free money.
And
right?
They thought no risk
Right.
at all.
You're gonna pay me to guarantee something that will never default anyway. Sign me up for that. How can I do trillions of this? It's great. It's a fantastic way of doing business or adding to your business lines, because remember, there are all kinds of sophisticated quantitative models behind all of these transactions that all of them say, yes, this is perfectly safe. Everything we're going to do is going to work out terrific. This is just free money for us. It's free leverage it's not free leverage, but it's cheap leverage for the bank. They're able to expand their balance sheets and make them more efficient, leverage up. It works for what could possibly go wrong?
Right. Housing prices always go up, but
Yeah.
that's not where the story ends, because people would say, and I know Eric pointed this out really well. He said, well, wait a minute, Jeff, but isn't Bank A increasing their balance sheet or decreasing the balance sheet capacity by selling them this insurance, this $40 insurance against the $40 in risky mortgage-backed securities that the Bank B wants to be not as risky so they can continue to lever up? And your point was, well, you got to understand, they're not putting the $40 of insurance that they gave Bank B on their balance sheet.
Goes in the footnotes.
They do, it's just a little teeny weeny bit, because again, there's no risk whatsoever, because we know that housing prices always go up. So if there's $40 of insurance that they are actually liable for on their balance sheet, it might not even be there. And if it was, it would be like, 10 cents or something like that.
Yeah. How do you account for an insurance policy that hasn't paid out? It's a guarantee for some future event. You account for it by the present value of that future event. Who gets to decide what the present value of that future event is? Well, you do. So you get to price your own insurance policy because it's all this complex black box model stuff. And so you say the probability that I'm going to pay out that $40 as the issuer of that credit default swap is essentially zero, or it's so infinitesimally, never mind. It's so small. I can't say the word. It's so small. I'm going to put this little tiny amount on my balance sheet in the footnotes. It doesn't even have to necessarily go on the liability side. I'll put a note on the footnotes that says, if these conditions are met, I might have to pay out this $40. So as far as AIG or the insurance company or whoever's writing the credit default swap goes, it just kind of disappears into the minutia.
Yeah.
Whereas for Bank B, you've got all this leverage based on a guarantee from somebody else that we can't really define or trace. And it's this shadow leverage, as I call it, or dark leverage.
Yeah, and what people, okay, first a question, then I want to point out something. So technically, if this did go on the balance sheet, would that go on the liability side or the asset or both? Because it's technically both, isn't it?
It depends on the market value, but it would be more of a liability than anything.
Okay, so what asset do they offset that with?
Its own. See, that's the thing. It's an asset and a liability because
Yeah,
it's
that's
an
my
asset
point.
because it's earning premiums, but it's
Right,
also a liability because it has
might have
this
to pay out.
trigger down the road. And so there's a complex set of formulas that you have to use to come up with a market value. Is it positive or is it negative? So if
Mm,
there's a positive market value, it's an asset. If there's a
got it.
negative market value, it's a liability. And
Got
that
it.
all
Okay.
runs through the income statement to get to the balance sheet. So
Okay.
this, again, our point is you have to understand accounting to understand the leverage and the money that's involved here.
Now, the next thing I want to point out is that Bank A could buy $40, or Bank B could lend Bank A $40 that they could use to buy the risky mortgages. And then they could get insurance from Bank B in the form of these credit default swaps. And then they could lower the risk of, or at least from a regulatory standpoint, from those risky mortgages to down to not risky mortgages. And then they could have more balance sheet capacity. So they're lending each other the money to buy the assets, and then they're insuring those assets so they can continue to expand their balance sheets.
Yeah, and that is as preposterous and ridiculous as that sound. You got to remember, Bank A and Bank B; these are behemoths. So the desk that's selling credit default swaps is not going to be the same desk that's lending. So the fact that Bank A is selling Bank B credit default swaps and Bank B is selling Bank A credit default swaps, they're different parts of different banks, and they don't even talk to each other. So it's not as ridiculous as it might sound.
But this is what happens. This is why people have to understand these banks are not constrained in any way, shape, or form
They're
by bank
constrained by
reserves
accounting
or
rules. That's
anything.
really what it is. And present value calculations.
Yeah.
That's what I really didn't get much into here, but present value calculations are important in all of these things.
Yeah. So before we move on, when would a bank choose to going back to those three options? When would a bank choose to settle with another bank in the form of bank reserves that are on the bank's balance sheet, or the Fed's balance sheet, excuse me? Because going back to the CHIPS system, the way I understood it is you've got just millions of transactions going back and forth, and the CHIPS algorithm is kind of netting out those transactions.
In real time.
Yeah, in real time. So then at the end of the day, when they want to settle up, if they want to settle up on the Fed's balance sheet, then CHIPS says, okay, Bank A, you owe, after all these millions of transactions going back and forth, you owe Bank B $10. And then they settle through FedWire, where the Fed then just takes the $10 of bank reserves, moves it from Bank B's account to Bank A or vice versa. And that's how the final settlement is done. But that would be option one, where they actually wanted to give them an asset to go along with that additional. What if they just use those Nostro or Vostro accounts? I'm assuming
Well,
that doesn't. Go ahead.
no, I was going to say, yeah, you can do it that way, but you got to remember with CHIPS and the CHIPS situation that you have those 43 bank participants that are actually the ones who are on the hook for all these hundreds of other banks that they've sponsored into the system. So those 43 might, the Bank A and Bank B might be one of the 43. They're the ones who are settling through FedWire, but Bank A, say at the end of the day, maybe owes some money to Bank B on behalf of Bank C, which is not a participating member, which means that Bank C owes Bank A some cash, which can be settled in a correspondent relationship or some other way. So even though Bank B or Bank A owes Bank B some, they might transfer some bank reserves to settle out what they owe on behalf of Bank C, there still needs to be some settlement down the road between Bank A and Bank C because of the sponsored relationship there. And that might not be settled in federal, it might not be settled in bank reserves or on FedWire. That's probably going to be settled on their correspondent relationship.
That's where I was going. So that doesn't have to be settled in bank reserves it doesn't have to be settled on the Fed's balance sheet. It can just be settled on the balance sheets of the commercial banks themselves.
In fact, that's what mostly happened. And that's why there were so few systemic bank reserves before Lehman Brothers, is because everything got settled on its own terms in these correspondent accounts and these pass-through or payment through accounts.
Yeah. Okay, so guys, if you think that is crazy, just wait a minute, because what Bank B can do is they can say, "Oh my gosh, Bank A, that worked so well." Or am I getting ahead of myself? Oh yeah, here it is. They can say, "Oh my gosh, Bank A, that works so well. Why don't you just lend us another $40 and we'll just do it again?"
Exactly.
Yeah. So do you want to walk us through this? The
It's
balance
just,
sheet?
yeah, we just repeat the process. We've
Yeah.
got risky mortgages. It doesn't necessarily be subprime mortgages, but some form of risky asset, risky loans packaged together, syndicated, whatever. It could be junk corporates, it could be prime corporates, it could be any number of debt forms. And at the end of the day, because we have some form of guarantee, some form of offsetting liability that is consistent with the regulatory and accounting rules, we've turned what would have been a 100% risk-weighted asset into a 20% risk-weighted asset, which means our leverage goes up to 18 to 1, even though our capital ratio only goes down to 8.6%. So far as regulators are concerned, as so far as the public is concerned, this bank looks like it's on the up and up. It's a very fine-standing institution that is doing nothing risky whatsoever, even as its leverage ratio continues to rise farther and farther.
Yeah, there you go. And then I think you give one last example of, oh, now we've got 4 banks in the mix. So I'm sure this gets really interesting.
Yeah, now we're talking about, I believe this is, what happens on the if we have outside credit default swaps or other guarantees. How does that fit into, where does it actually go on the balance sheet? How can we trace that leverage backwards into where it comes from? And as we see with Bank D, which is, I think, the originator of the actual guarantee, it's just it's a minor footnote somewhere that maybe it gets on the bank balance sheet as a dollar something else somewhere along the way, but it's you can't really see all of these derivatives and what they're actually doing insofar as supplying the ability of these other banks to create leverage from nothing.
Right. So the bottom line is, it's in the first example you were using CDSs, and here you're just saying they can basically do the exact same thing with another type of derivative, which is just a currency swap.
Or an interest rate swap or some other kind of derivative that controls essentially the volatility or the modeled volatility that goes into these present value calculations, right? So if you have a derivative contract and it's paying you some form of premium, that's a positive asset value. But a balance against that, as I said before, was the probability that you're going to experience a cash payout against you. And what is that probability function based on? It's based on modeled volatility. We look back in time and look at what does the volatility normally look like in this space, and we can decide how likely it is we're going to experience a payout. And if that likelihood is high, why not buy another form of derivative to control the calculations about how we're going to ever have to pay out on the liability side. So It's essentially controlling the mathematics behind all of these balance sheet behaviors.
And I also want to point out to everyone that what we're doing here, we're talking about money printing. That's what the banks are doing. They're printing money. They're creating dollars out of nowhere to buy the mortgage-backed securities in the first place.
It goes back to the example you started with, George, right? That somebody ends up with a deposit liability or some form of liability at the bank that they can then use in the real economy. So banks are creating credit, money. The lines between the two are blurred, but they're creating this out of thin air, and they're doing so based upon there's these internal balance sheet constraints, not whether or not they have cash in a vault somewhere, but whether or not it makes sense with regulatory rules, accounting rules, as well as some internal numbers that are assigned based on what bank managers think you should be doing.
Yeah. So now I want to come full circle here, and let's see how we're doing on time. Oh, almost an hour. Okay. Do you have a couple more minutes, Jeff, or are you running short on time?
Yeah, we can finish this up.
Okay. So I want to come full circle because the title of the video was talking about how this pertains to Russia. So, and the SWIFT and the sanctions and whatnot, and the Russian banks communicating with the German banks if they want to move natural gas back and forth. And so we outlined that at the beginning, But one of the reasons I wanted to go through the bank's balance sheet, not is just to get everyone up to speed on how that works and how there's no constraints, but to also highlight that where there's a will, there's a way, I think
Yes.
is the main takeaway here with these banks. And if you thought that the politicians could come in and just say, shame on you, Russia, and I'm not saying that they shouldn't do something. I'm not saying that, we're not looking at whether or not Russia's to blame or they should. We're just looking at, the facts as to how they pertain to the bank's balance sheets and what they can and can't do. To think that the regulators can control these banks if they want to do something is absolutely ridiculous. And it's just showing, I think, an ignorance of how the banking system truly works. And would you agree with that, Jeff, or am I off there a little bit?
No, I think that's the entire point that we need to reinforce over and over as many times as we can, because the public perception is the government, the Fed in particular, are these all-powerful institutions. And when it comes to the US dollar and the US dollar system, which we're all taught as the global reserve currency, the Treasury, the Fed, the government, the US government, they're in control of the US dollar. Therefore, they can do whatever the hell they want, whenever the hell they want. And this is a perfect example, an inadvertent example, where we can see that that's not the case. In fact, the US government and the Treasury Department, the Federal Reserve, they really don't have much of a role in this entire system, because it's a bank-centered system that operates between banks, essentially a computerized network that operates globally. And as I said before, if they do want to exert political pressure on parts of it to say, you've got to cut off this list of 10 Russian banks from SWIFT, then other parts of the system are just going to pick up the slack, because that is how the system put itself together. It wasn't designed, but that's how it put itself together in an ad hoc nature over many, many, many decades. And so the system is very good at least doing that, at least rerouting resources as they need to be done. Where it has come up short since 2007 and 2008 is in all of these balance sheet mechanic techniques and management techniques and all the ways that balance sheets are constrained by these other things, not by regulations, not by rules, not by governments, and not by politics. So the system, as far as, managing transactions, it can do any number of things regardless of the inputs.
Yeah, and regardless of what the regulators want them to do, they can hide it. They can, it's not just out in the open. They can do all these backdoor deals and financial engineering to get the job done. What do you think of the Chinese alternative to SWIFT, the CIPS?
I think it has limited use. I think it's going to be, I suppose it's going to be something that the Chinese are going to maybe highlight, but there is no infrastructure behind it. There isn't a whole lot of reach into it.
Is it an option for the Russian banks to get around the exclusion from SWIFT?
Only in the block that trades in Chinese yuan, which is exceedingly small. And I know the dollar doomists say, well, that's the point. It's going to get big. It's going to replace the dollar system. But as we just said, and as we just went over, in order to undertake the roles of a true reserve currency, which means you have to have the currency, not physical currency, but the currency capacity to trade everywhere, then it really doesn't do you any good if you have these interbank systems that are only applicable in very narrow circumstances. So any trade between Russia and China could be settled on CIPS. Sure, that's easy. The Russians have yuan-denominated reserves. They can pay for them. They can do trade in bilateral arrangements. But that doesn't help Russia sell its gas in the global marketplace, because most gas energy buyers, they're not going to trade in Chinese yuan at all. So the Russians are going to end up in US dollar denominated assets at some point, and the question is, how do they deal with them?
Yeah. Okay.
And there's options for them to do so.
Right. That's the main point. A quick couple questions. Does SWIFT and chips work exclusively with dollars, or are there multi-currencies involved there?
No, they're exclusively US dollars. And so for example, internet settlement in pound sterling, there's something called CHAPS,
right?
Which is kind of where chips came from. It's sort of a mimicking what the British had done. Again, the British mercantile system.
They're equivalent to FedWire. Is that correct?
Yes. So there's foreign currencies. There's Euroclear, which does a lot of clearing and settlement in Europe, based in euro-denominated assets and liabilities there too.
Okay, Jeff, we'll leave it at that, man. For my viewers who want to find out more about what you do, where can they go? Let's talk about the podcast with Emil Making Sense. Alhambra, all you're right. I think Real Clear Markets is another place. Where can they find you?
Yeah, and I've just started writing a column for the Epic Times. So there's Real Clear Markets, where I do a weekly essay, long form essay, diving into these deep diving into these topics. My company's blog at alhambrapartners.com. I usually a couple things a day there. Again, researching macro, money, all the Eurodollar stuff. And then Emil and I in our podcast, Eurodollar University. It's on YouTube, Apple iTunes, anywhere you can get podcast stuff. We can find us there.
All right, Jeff, thanks a lot for coming on. As always, an incredible conversation, and I can't wait to do it again. Enjoy the rest of your day, buddy.
All right. Thanks, George. Take care.